Welcome to our investor presentation, which highlights what we've been able to accomplish in our past 10 years for Joker Shoes Company. Introducing my team: Benito Villaseñor, Ben Sweet, Jared Erickson, Oscar Pedromo, Gabe Green, Josh Melvin, and myself, Nancy Garcia. Here is our strategic vision. Starting off with our strategy, which we used in our past 10 years, which was differentiation strategy. Our vision statement: to be the leader of the market and set high standards of quality and designs for shoes. Our mission statement: Joker Shoes Company is committed to deliver a product to our customer that sets the industry standards for quality at a competitive price. In continuation, our key points that we will be covering during this presentation: trends in revenue, results for earnings per share, presented by Josh, annual returns on equity, investment and trends, approach to credit rating, trends in stock price and image rating, presented by Gabe, investment wholesale strategy, presented by Benito, private label strategy, presented by Ben, production strategy, finance strategy, presented by Jared, competitors and lesson learned, presented by Oscar. I will now hand it over to Josh, who will present trends in revenue.
Hello, my name is Josh Melvin, and I'm going to be covering the 10-year net revenue results for Joker Company. Now, for Joker Company, our focus was always attempting to maximize our net revenues as we moved forward. Now, you'll see on the chart here and in the numbers down below that there are two specific times when we didn't increase our net revenues. This was in year 14 and in year 17 here on the chart. Year 14 was specifically due to a abnormally high exchange rate adjustment that caused our company to be unable to meet continued growth from year 13 to year 14. This was an industry-wide effect. It wasn't just affecting us. And so while it appears that there was a slowdown there in year 14, in retrospect, looking at the industry, we did quite well even in year 14. Now, year 17, the second dip, comes from a intentional transition from utilizing a high debt strategy to utilizing an almost no debt strategy. And that transition was mellowed as much as we could mellow it. And as you could see, after year 17 into 18, 19, and 20, we saw our revenues back up higher and higher than we had ever before. So as we continue moving forward, our company is doing very well net revenue wise, and looking forward, we expect to continue to be able to do so. And that moves us on to earnings per share. The overall goal we set forward for earnings per share is growth. To achieve this goal, Joker Shoes decided early on to buy back shares of stock. With this plan of buying back shares, every share bought early, even with debt, would be cheaper than if we had waited later to buy those shares back. The strategy worked well, as you can see from the graph above. The earnings per share grew or stayed very close to the same year over year, with the major exception of year 17. Again, year 17 was a planned sacrifice in earnings per share as we transitioned from the debt utilization strategy. Having completed the initial debt-based growth phase, minor shock in the earnings per share is to be expected. With that said, we expect earnings per share to continue to grow on an upward trajectory for as long as demand rises and we repurchase outstanding stock.
Thanks, Josh. I'm Gabe. I'd like to speak for a few minutes about a credit rating, return on equity, stock price, and image rating. Because we approached this 10-year period in 3 phases, our credit score was subject to a large anticipated swing. During the first phase, which covered the first 4 years, the goal was to compete using a broad differentiation strategy focused on producing high-quality products at prices that set our product apart from the industry standard, while investing heavily into cumulative efforts, including TQM, Six Sigma, best practices training, and competitive compensation packages, while simultaneously aggressively pursuing stock buybacks. The next phase covers years 15, 16, and 17. The main focus was to maintain a high-quality product while shifting to cost reduction with an emphasis on expansion and an efficient exploitation of economies of scale. A secondary and equally important element of this phase was to eliminate the outstanding debts accumulated through Phase 1 while increasing revenues and profit margins. During the final phase, we integrated a blend of both differentiation and cost leadership strategies by taking advantage of investment initiatives from early phases. Set the industry standard with a quality product that's sold at a price below the industry average, producing our product at the lowest cost per SQ with an industry-leading market share, net revenue, and profit margin. This is all only possible after debt repayment efforts accomplished during Phase 2. Since we agreed to take on that debt, we had the ability to purchase the maximum number of shares that ownership allowed year over year through year 14, where the cost of purchasing just over 1.1 million shares at $248.52 per share is shown here. That expense reduced the total shareholder equity by $170 million, bringing the new shareholder equity to a value substantially lower than our after-tax profit. As we shifted our focus of debt repayment in year 15, we pulled back slightly from our stock repurchasing initiative, which is where we start to see total shareholder equity begin to rise slightly, while still remaining well below net profit. As a result of achieving these new low shareholder equity values while maintaining sales and net profits, our company was able to realize a return on equity in year 15 that eclipsed 150%. The net effect of that spike is an average return on equity over the entire period that's twice that of our closest competitor, essentially limiting their ability to compete. While the overall stock price trend is positive for the duration of our management period, we do see two very slight dips at the end of each of our strategic phases. This is because stock price is a function of growth. In year 14, we focused on repurchasing stock, paying maximum amounts into cumulative efforts, and expanding facilities for future benefits as we experienced an anticipated dip. As we began to pull back on cumulative spending initiatives and stock repurchases, we see a large growth until year 17, where we again experience an anticipated dip due to the last push towards maximizing profits moving forward. Over the final 3 years, we've enjoyed a large increase in stock price, and we've every expectation that this trend should continue over the next 3 to 5 years. The first factor that contributes to image rating is SQ rating. We're proud to have maintained one of the highest ratings in the industry for the duration of our management, while enjoying growing revenue and profits. Another factor contributing to the image rating is market share, both global and branded. We captured 15 to 20% of the branded market, wholesale market, and remained the industry leader in this area while constantly capturing 20% of the private label market demand. Finally, we decided to participate heavily in corporate citizenship initiatives from year one and slightly increase spending in this area when possible. As a result of our focus in these 3 areas, we were given an image rating of 100 in every year. Thanks for your time. I'm going to hand it over to my co-manager, Benito, who will speak for a few moments about our wholesale and internet strategies.
Thanks, Gabe. My name is Benito, and I will be talking about our wholesale strategy and internet strategy. Before I start, I want to say that all the graphs I'm going to use are from our North America region, but the same trends are present in the other 3 regions as well. Our wholesale strategy starts with our price. We set a high price because we were spending money to use superior materials, increase the number of models we offered, and the styling features of our shoes. This allowed us to cover these costs and still make a profit. As years went on, we were able to lower our prices while also continuing to offer the same high quality shoes. As you can see in the graph at the top left, as the industry average SQ rating in red went up, so did the industry average price in blue. As for Joker shoes, the graph on the top right, our SQ rating in red stayed roughly the same, but our prices in blue were going down. Then we move on to our brand advertising. By heavily investing in brand advertising, we were able to get our brand out there and stimulate demand. As you can see in the graph at the bottom left, we were consistently spending above the industry average, allowing us to create more demand for our shoes. Next, we didn't really focus on our rebate offers and delivery time, other than to just maximize our yearly projections. Finally, we reached retailer support. We really wanted to dominate the industry. By spending a lot of money on retailer support in the beginning years, we were able to increase the number of retailers willing to sell our shoes. As you can see in the graph at the bottom right, Joker Shoes in red was consistently spending above the industry average in blue on retailer support. Eventually, we started decreasing the amount of money we spent on retailer support because we had so many retailers already willing to sell our shoes. Now we go into our internet strategy. Our internet strategy was mainly based off of our wholesale strategy. For example, the retail price of our shoes exceeded the wholesale price by 40% exactly because anything less than that would upset our retailers. If this happened, then retailers were not willing to be willing to carry our shoes, thus destroying the benefit we were trying to achieve by investing heavily in retailer support. As you can see on the graph on the bottom, our internet price in blue and retail price in red followed the same trends. They were exactly the same distance away from each other at all times because we didn't want to upset our retailers. For search engine advertising, we had the same goal as with brand advertising, to get our brand out there and to stimulate demand for our shoes. As you can see in the graph at the top right, Joker Shoes in red was consistently spending above the industry average on search engine advertising, allowing us to stimulate more demand for our shoes. We didn't really focus on free delivery. Now I'm handing it over to my co-manager Ben, who will be talking about our private label strategy.
For us at Joker Shoes allowed us to learn and adapt, to face adversity and a setback and learn and try to become more profitable. Early in year 10, we had made a plan as a group to really focus on trying to capture a large market share of private label. So those first 3 years, we saw a very significant increase. By the time we got to year 13, we decided we were going to really go for it, and we overshot. And we saw a revenue dip from year 13 to 14 after we were not able to meet the demands. We're only partially allowed to get there. So after year 13, our company and our management team decided we were going to hold about 20% of the market share and try to consistently hold that market share for the rest of the time. This allowed us production of the same quantity of shoes while maintaining profits over 20%. Individually, we found the most profitable region was Asia Pacific, which saw our margin costs over direct costs were always higher than the amount of products sold. Where we saw most volatility was in Latin America, where we saw a lot of margin dips from year to year. And the least profitable was in Europe, Africa, where we saw a very low margin over direct cost comparative to the other regions, versus North America, which was pretty stable for us the most of the time. And we were able to increase in our revenue and margin over direct costs steadily after year 13, back up to a point of a new high point when we ended in year 20.
Moving forward with our production strategy, as a group, we thought it was really important to take advantage of best practices training and invest in those employees and our workers within our production facilities so that we could boost that overall productivity per worker. And that really was helpful to us, especially over the years while we were expanding. Once we were able to expand overseas, we decided to take advantage of Option C, which with that special equipment, we were able to boost our SQ rating per shoe up by 1 star, which was really important to us. And when we were able to increase that overall productivity of the workers and still be able to expand, we took advantage of economies of scale, and you can kind of see that our overall production costs decreased over the years. And that was something that we really important to us, was decreasing our production costs while still maintaining that high 9-star quality shoe. Moving forward with our finance strategy, luckily for us, we had Gabe and Josh on our team, and they were probably 2 of the students that knew the most about the how the whole simulation worked. And that was really important for our success. And after reading the player guide a couple times, they decided that it was really important for us to expand in the early years. There was a lot of teams, including some of our team members, including myself, that we were a little nervous about expanding earlier while we didn't have the money and we didn't really want to take on that debt because we were afraid that we weren't going to be able to pay it off. But Gabe and Josh said it was extremely important to expand early so we can kind of get ahead of the game, because we're going to be able to expand and still increase our net revenue and pay off that debt, and it wouldn't be an issue. So that's what, to us, it was really important to take on that debt and not be afraid to take on that risk and pay off the debt as quickly as possible. And that's kind of how we were able to increase our stock price and our EPS over the years. We would pay off our debt and then repurchase our shares, as many as that we could, or as many as that we kind of wanted. And especially in years 18, 19, and 20, you can kind of see our EPS and our stock price just jump up a ton. And that was because we thought it was really important to repurchase those shares and decrease that number of shares outstanding, which overall boosted that EPS and our stock price and our image rating, which was really important to us. But moving forward, we're going to be talking about our competitors.
Hello, my name is Oscar Perdomo, and today I'll be talking about competitors and lessons learned in the business strategy game. One outlier was Team G. Team G also found success in obtaining a high image rating, ended with a game-to-date score of 22, falling behind us with a 24. After analyzing Team G, we came to the conclusion that they overcharged consumers based on lack of product quality. Another outlier for us was Team H. Team H caught a comparable end of the market share with 20% in private label segment, as Team Joker Shoes fell shortly behind in 19.9% of private label. They captured an opposite end of the consumer base because Team H offered cheaper shoes in internet segment, wholesale, and private label segments compared to Team Joker Shoes. Some of the lessons learned in the business strategy game is that SQ ratings matter. We were able to bump up SQ ratings by going into corporate responsibility. One thing we also learned quickly is that it is super important to just take risks. We realized pretty quickly that if we had taken out larger loans, preferably in year 1 or 2, we would have been able to expand a lot more quickly. We also learned how to get a high ROE. We got a high ROE by reducing shareholder equity through stock buybacks. We also obtained it by increasing net income, by reducing production costs in our facilities, especially overseas. This buyback also resulted in an increase in stock prices. Overall, we learned that strategizing long-term plans of action can cause temporary dips, but these early investments actually pay off in the long run, and the outcome of our early investments allowed us to enjoy the fruits of our labor through very high market shares and good metrics. Thank you.